how to find the best suburb for investment across Australia. We'll talk about good suburbs. What is the definition of a good suburb now? And then about how do you really find one? The essence of a good suburb is what we'll talk about. We'll talk about key matrices which define good one, and then obviously we'll have queries at the end. We'll love to take all your questions. Please type in as and when you feel like in the Q&A section, and we'll take all of them at the end. Good evening. Welcome to our new webinar on Webinar Tuesdays. Before we move ahead, a quick disclaimer to all of us. This webinar is only for information purpose. Please note, we are not passing any advice. We are not passing any bit of financial advice to all of you. If you need proper financial advice, you should keep on talking to your professional advisor, which is accountant or your mortgage broker or your financial planner, whoever you really talk to. All right, without waiting any further, I think we've got heaps of people already into the webinar, and we'll not wait anymore. It's a very, very interesting topic, and we'll all have a lot of fun discussing and talking to all of you. What I would request all of you to please, you can keep on putting your questions in the Q&A panel. If you have anything which you want to talk to us about, please do so. If you have any question, please keep on punching into the Q&A section, and we'll have that bit with us. So we'll take all the questions at the end. But let's move forward quickly with the agenda. We'll be talking about PropWealth. We'll be talking about Infinity Financials. So just quickly, we'll glance through what we are all doing. How do we begin our search? We'll be talking about what's a good suburb, and that's an important definition for every one of us to understand what actually is a good suburb. Why do we call something a good suburb? What do we call something a good suburb? And then we go forward into finding good suburb matrices. We'll love to take questions. If you have any question on any particular suburb you want to know about, please type into the Q&A section, and we'll take them all at the end. Normally, this webinar extends a bit, 5 to 10 minutes. I hope we don't extend today, but depends on the questions flow. If you have more and more questions, keep on punching in, we keep on going. But at the end, we'll talk about the next locations, which are really showing boom. And in this market, when the rates are going to go down, and we're all hoping that it's going to become affordable for all of us, they are very critical ones. And you can do it yourself through these locations and find something really nice for you, obviously. And you can also get in touch with PropWealth if you think at some point of time that you want their help to get into properties. But right now, very quickly, in front of you today with us, it's Julius. Julius is a head of research and in acquisition, and he's got years and years of experience in IT. He's got so many properties which acquired across Australia and New Zealand, specializes in data, specializes in all of these things, and has been a great person to work with. I think so many of us have really interacted with him and found him really nice. Joined with him is Parag, Dixit, that's myself. And I've been a mortgage broker, and I've served heaps and heaps of clients in all these years. And it's been a privilege to work for people, and it's been a privilege that I'm able to give guidance and advice to people, and they've really benefited out of it. But yeah, that's me, and I think we will all know about us in some time. But yeah, about PropWealth. PropWealth is it's a number one agency right now. It's really booming. It's really doing very well. We have so many clients which are taking the advantage of PropWealth and getting properties through them. They're pretty premium, and they are one of the very few who have their own data matrix, and they follow the matrix and try and identify locations which are going to do better in the future. Infinity Financials, very quickly again, we've served more than 10,000 clients in some capacity or the other, and we've been top 10 mortgage brokers for Australia for the last few years, and it's been, again, as I said, been a privilege to work with so many people. All right, very quickly, can I have a quick poll, and can you just quickly type into the chat, how do you begin your property search? Which of these do you really use? Just type 1, 2, 3, or 4. Recommendation by friend and family, Google, friends, wherever they've invested, that's where I invest, or media articles. I read something in the media, and I think this is what it is. This is what it is. Just type 1, 2, 3, and 4. It'll be great if you type something there. 1, 2, 3, and 4. 4. Oh, that's nice. 3, 4, 1, 4. Mix of everything. All right. Okay. 1, 1, 1, 4, 1, 3, four, four, four. All right, a lot of four, a lot of mixes, a lot of fours. One, all right. Three, and that's nice. That's very good. That's very good. That's fantastic. I think that's a good way to do that. And absolutely none of them are wrong. There is no right and wrong answer to this. But what we want to really achieve on is, if we are going by what's coming up in the media, if we are going by what's coming up on Google, is that the right way? But what's more important for us to realize is, what is the definition of a good suburb? What does it mean when we say this is a good suburb? And that's very critical to understand. It's critical to understand what's a good suburb, because that is what is going to drive your strategy. It's critical to understand what's a good suburb, because that's how you really invest and make money. If you have $500,000 with you, and that $500,000 is going to drive your income, is going to drive your wealth, then that 500,000 better be invested in a suburb which is going to yield something great to you. And that's why for all of us, it's important that we identify the definition of a good suburb and we go as per that. What is a good suburb? First, let's bifurcate into owner-occupied and investment. What is a good suburb to live and what's a good suburb to invest? Are they the same? Very quickly again, okay? Are they the same? Can you just type 1 if it's the same? Can you type 2 if it's not the same? 1, same, 2, not the same. Same, 2, 1, 2, 1, 2, 2, 2, 1, 1, 2, 2, 2, 2, 1, 2, 2, 1, 2. Oh, that's a good mix of a response. That's great. Okay, let's quickly get down into what we are talking. Let's say, what do you think in a good suburb to live in? I think if you all have kids, if any one of us have kids, then first is school. So many times people will come, I want to buy in a catchment, in that catchment, in this catchment. What is the catchment? You see a house, first thing you see is what's the catchment? Schools, very important for all of us to find out which school are we, the suburb, the house falls into. Whereas you may have a lower school. Till it's affordable for you, you will invest, because somebody is studying in that school, and not everybody wants to have the school as the most important thing. When you're renting, when you don't have children, when you have younger children, or you have elder children which are into college, you don't worry about schools. A lot of people will invest looking at affordability. Transport, you want to go to work, transport is a way to go for living. But when you want to invest, you want somebody to take that house. You don't care whether that person really needs transport or has a car of his own, but it should be that area has a low vacancy rate. That's important for me. The markets to be nearby, but maybe I look at demand and supply ratio there, because I want to get most bang of my buck. I want to get most rental out of it. I want to get the maximum money out of it. That will come by rental demand and supply. And Julius is going to talk about it in the presentation at some point of time. And that's an important criteria. Socioeconomic, I think that's important for both of these. You want to have it in a good socioeconomic area. Again, a topic which Julius will touch upon. I don't want to dwell on it for long, but that's an important critical thing, both whether you want to live or you want to invest. And that's how you get more money, more capital gains. But again, we'll talk about that. To live in, you would definitely want to live in near your family, friends, and all this. You don't want to travel 1 hour to meet your family and friends, and then, or you obviously, if you want to have more, then it's a different thing, but preferably stay near them, and then you can always catch up with them, have a couple of barbecues, have something dinner, and have something good during the week or end of the week. But in terms of investment, it doesn't matter, because you're not staying there. So it's a good infrastructure, so that somebody who's staying there on rent for you, he's able to or she's able to take advantage of that, and you are able to grow in property value because somebody else wants to stay there now. So very quickly, what's the impact of these? In both the cases, the first one, definitely we get great capital growth, right? In the transport or the low vacancy areas, that's where you get cash flow. And that's how sometimes a good suburb for me becomes a good cash flow suburb. And I'll talk about this very quickly. The third point, capital growth. Again, this is a driver. Socioeconomy definitely drives capital growth. A good socioeconomy area keeps on getting more properties, keeps on getting more value out of that, and keeps on growing in value. friends and family. Obviously, I want to live there, so I'm happy to pay 20 grand more, 30 grand more because my friends and family stay there, or there is a great infrastructure growth in the area. So that's where I would want to be. All right, okay. Next question. Are all suburbs good for everyone? Now I'll give you some examples, okay? Are all suburbs good for everyone? If all suburbs are good for everyone, everyone will be investing in only one suburb, right? But for me, person A, I want high capital growth. I can afford $1,000 negative cash flow. So maybe some suburb where it's a negative, very high negative gearing, I'm fine. And this is a good suburb for me because I think if with high negative gearing, I may have a great capital growth. So I love that. That's a good suburb for me. But for my friend, he wants high capital growth, but cannot afford negative cash flow. I can't afford to put in $100 from my pocket into a rental reserve. So a good suburb for me changes. Good capital growth, but I don't want to put anything from my pocket. Different definition, different suburb for me. My third friend, he says, I don't care about capital growth. I just want the property to pay for itself. Please don't impact my personal life. I don't want to cut down on my coffees. I don't want to cut down on my pizzas. I want it to pay for itself. For somebody else, some of my best guys, they say, I want to save tax, man. Cash flow is not a problem. Capital growth, not a problem, but it should be negatively geared, and I'm happy with that. Till it's negatively geared, I don't care. It is saving me tax. Or it can grow in capital, maybe lower growth, but it should get me some tax benefit. I am paying heaps of tax, and I think I would love to save some tax on that. Different definition for everyone. That's because we all are different, and that's very important. That's how the definition of a good suburb comes into being. What is a good suburb? Let's get into quick examples, okay? Quick examples of all these four. And then we will get into how do you find good suburb. Very quick example, Kellyville in NSW. If people are there from Sydney, they will understand this suburb. If you read on the score, about 1.9 million is on the screen. 1.9 million is the average price, and more than 80% are owner-occupier. Good suburb? Definitely good suburb, right? All of you will agree, good suburb. It's a great suburb to be in. That's how the house value prices have grown in the last few years. And it has grown pretty well in the last few years. So in terms of sale, on the graph which you see there, the number of properties sold versus the median value, and you can say the median value has been growing steadily. Houses for rent, you can see the last 12-month rental income trend. Number of houses for rent is there, but rental yield, that's the one on the right. Now that doesn't look pretty, okay? Rent amount may be increasing, but rental yields not. So what's the synopsis of this one? 5-year price rise, 55% capital growth, okay? 5 years rent increase, 36% rent increase. So rent increase is not kept in step with the price rise. So what it has done, there is a degrowth of rental yields, and which is 24% degrowth, which sits now, a rental yield sits now at a median of somewhere around 2.5%, 2.45% to be exact. Now that's in scenario one. I want high capital growth, and I'm okay to pay $1,000 from my pocket, or whatever be in this case. Kellyville will be pretty high, maybe a few $1,000 from my pocket. With a 2.45 rental yield, we really need to have a good cash flow on our side to be able to take care of this negativity. But still, people love to invest there, and it's a great suburb, but not for me, maybe for somebody else. Next one. Okay, let's take a regional NSW example. Albury, okay? Albury has been recommended by us for quite some time. It's a good growth corridor, and a lot of people have enjoyed benefits out of that. Let's read that suburb. We've got about $600,000 of average property price, and we've got about in this suburb we've got about 60% who are owner occupiers, and rest are investors. So a good mix there. That's the property price rise. It kept on rising, was stable for some time, and it's now it started creeping up a bit from there. And how's the rent moving? Rents moved very well around the last 12 months. It's dipped very slightly, but then it moved up. Rental yields, that was dropping when the price was rising, but now the rental yields have also started going up. What does that mean? Again, a quick synopsis. 5-year rental price rise, 73%. 5-year rent rise, 53%. So 5-year rental yield degrowth is about 12%. That's because the price rises, median price is lower than Kellyville. That's why you find that the degrowth is a bit lower. And the rental yield now sits just below 4%. 4%, still negatively geared. I am a bit negatively geared, but not as large as Kellyville. But because my cost base is lower, so the amount I'm paying from my pocket is a bit lower. Medium cash flow kind of a property. Let's go into a WA property, okay? WA was in news for quite some time and is continuing to be in the news. A lot of discussions around WA, whether it's going to continue to rise or not continue to rise. Let's see. Very quick one. Bertram was a very, very popular suburb with a lot of investors, and it still is. We still don't find supply in there in that location. 600 plus as a median price, and we find that we are there with about 70% owner occupier, 30% are investors. A good place to invest if someone wants to, because people want to stay there. That's the houses for sale, number of properties sold. Oh my God, look at the rental chart. Look at that rental chart. That's just going straight up, right? Rental yields you can see going straight down. Now, what does that mean? That's a suburb which has seen 123% price rise in the last 5 years. Phenomenal, right? Imagine if I could have bought a property 5 years ago. Why not? I would have bought 2-3 maybe. But then nobody told me, right? Anyways, 5 years, rent increased 93%. That's pretty good. It's kind of mimicking the price rise. Rental degrowth still, because obviously it did not really capture the same price rise as the property rise, is only 11%. But the best part is it still sits at 5% rental yield. So with this rate cut, I am now very close to getting neutrally geared. Very close to getting neutrally geared in this kind of a suburb. Very rare to have that, but still 5% is pretty, very pretty. Good cash flow suburb and also showing great capital growth. A lot of people say Perth has still a long way to go. They're looking at another 15 to 20% price rise in this calendar year. We've already spent 5 months, and it is growing from there. There's absolutely what we see from when we read from so many people that there's absolutely no supply. Maybe that's an indication of where it's going to go in some future. But okay, let's come back to a very interesting topic. A lot of people talk about Victoria, and there's so much of buzz around it. Is it going to grow? Is it not going to grow? Is it a gamble? Is it something which I'm just taking a bet on and hoping against hope that there will be something increased? Yesterday's budget was not pretty. If you guys follow the budget, if you guys follow what's happening in the economy, it was just not pretty. But that's not the topic right now. All right, what does this suburb look like? 650K again as a price. About 80% are owner occupied. But that has grown from 2016. Dropped in 2016 to 70%. So that's a drop. Investors are rising there. Owner occupiers are not. That's kind of a bit reverse. And that's the property price line. Okay, it's a bit stable. It's a bit dipping. It's a bit all over the place. Rents have gone up. Definitely have gone up. That's a good sign. Rental yields have gone up. That's a good sign again. So that's really nice. That's pretty rare out of the 4 locations which we picked up. Price rise for the last 5 years. That's not great, 23%, but yeah, you kind of just about meeting inflation. But yeah, whatever, it's grown. So where is the rental increase? 37% rental increase. So that's phenomenal. That's a very different thing. Okay, rental increase is higher, property increase is not. So that's maybe it's because it's a good cash flow. Don't talk to me about capital growth. Talk to me about getting rent, and rent is I'm very happy with rent. Okay, rental yield growth, 7%. Median is 4.45%. But mind you, net in Victoria is much lower than a lot of other states because of other costs and land tax thresholds being lower and all that stuff. But again, we have to see what are we looking at. If you're looking at a great cash flow, yes. More than median cash flow, in fact, yes. Great capital growth, not really. But let's see what the future holds for Victoria. But this is what it is. So we are talking about good cash flow, good suburb. So what's the definition of good suburb? What we are talking right now is we need to be really sure about what a good suburb means for me. A good suburb means for me is something different than what a good suburb means for you. And that's critical. What I need is maybe to invest into an Albany. What you need is maybe to invest into a Melbourne. And what somebody else needs is to maybe invest into a Bertram. But that's important, that what is something which I need and what is something which we need to do. where we need to invest, that will define my suburb, my great suburb. What is in your control are these three things: your income, your objectives, and your personal plans. And that's what should drive the strategy, not media. Not media, which we talked about, because good suburb for what media article somebody's published may be good for him or her, but not for you, because your objectives are different. So that strategy should define what it is. Market conditions are out of control of everyone. We don't know what's going to come in Victoria. We don't know what's going to come in WA. We don't know what's going to come in the commodity market. WA is a good dependent on commodity market. It's doing very well right now. We don't know, We don't know what Queensland will do if commodity market turns around and it becomes a bit bad. But what we know, what's my income, what's my expenses, what's my objective, what's my personal plan. That's all controllable for me, and that is what should drive my strategy. Hence, when you talk to somebody, your accountant, your provider, your advisor, your buyer agent, you should understand what's good for you, not what's good for everyone, because that may or may not suit you. And that brings us to the point about how to analyze this data. How do we really analyze this data, and how and what really brings us to a point where you can find out and say, okay, what's a good suburb for me? What it is? How do I really find out what is a good suburb for me? At this stage, I will hand over to Julius. Julius will take us forward from here and explain to us how we can find out about how to find a great suburb to invest.
Thank you, Parag, for the insightful session. Good evening, everyone. Let's discuss about how to find the next $1 million suburb. So when we start the investment journey for mid-size investor, or if you are into the starting of your investment journey, or if you are at the top of the investment journey, for every investor, there is the biggest question: whether my property will have a capital growth or not, or whether my property will have a good rental income, whether my property will have a good capital appreciation in terms of whether my property will have a good capital growth. Also, how do I find the good rentals? So there are a lot of questions, because in entire Australia there are more than 15,000 suburbs, and each suburb has more than 40 data points. And when you are into the different stage of the boom cycle, for an example, when you're at the peak of the boom cycle, each data point has a different weightage. When you're at the start of the boom cycle, every data point has a different weightage. So what to consider? Which data point we need to consider? Which data point has to be given the more weightage when you are at which type of the boom, as well as at what stage you are in. So according to that, we have to analyze the data. So how to consider the data seriousness, and then how to find out what's next $1 million suburb. To resolve this entire complex query, we built our own product called Propel Next, which been designed by us. It's our own proprietary product. So in Propel Next, basically we have 4 pillars. So in Propel Next, we get data from the multiple sources. We get raw data from multiple sources. We scrub the data. We put our own algorithm, and then according to the data experience as well as the market knowledge, we build the hypothesis around it by saying, okay, what are the current score? And according to the market cycle timing and whatever the market, and then whichever stage the market is, we define the scores, and we change the scores according to the market cycle timing. So we can estimate which suburbs will be the next $1 million suburb. Also, we do have a predictive analytical facility where we can understand how we can find out the suburb which is going to rise next in next 6 months. So we can get into that particular suburb of the councils before anyone else get into there. So in Propel Next, the first indicator is demand and supply related indicator. So in demand and supply, basically we look at, all the supply related indicators like stock on market. So for an example, if you look at the suburb where if you have 1,000 properties, and out of which, if suppose 100 properties are for the sale, then you have 10% stock on market. Then we look at the inventory also. So because stock on market has different thresholds. For an example, if currently the stock on market is lesser, or if it is more, but if the number of months of stock on market is less per inventory, then we see, for an example, stock on market is less than 1 or 2%. But if you have 6 to 7 months worth of stock still available in the market, then it's not good. So we track the inventory as well. So we take care of that data. So what we do is we get the entire raw inventory data from the multiple sources to understand what is the current stock on market and how much is inventory is remaining. We also look for the building approvals. Building approvals very important because we need to know, okay, currently suppose the stock on market is low, but there'll be time that, okay, if you have a lot of building approvals available, and then if that stock is going to be infused into the market, then suddenly you will have a more rise into the stock and market. So whenever we look at the stock and market related indicators, right, that time we see, okay, what is the absorption rate of the stock and market? So for an example, if the current stock and market is around, for an example, if you say the building approvals are around 100 approvals, and if the absorption rate of those building approvals are more than 90 to 100%, 90% or around 100%, that means whatever the stock is being generated by the new building approval is being absorbed by the market. If the absorption rate is low, that means whatever the new building approvals are coming into the system are adding into the more stock, and which is not good for the growth. So we check that. We also look for the hold periods. Hold periods are very important because if we get into the council of the suburb, if people are not selling after like 7 or 8 years, that means these are the suburbs which you need to consider because these are the stable suburbs with the good amenities and families would like to live there. Versus if people are continuously flipping the properties in next 2 to 3 years, that is not good for the entire suburb growth. That's because then basically you tend to have more number of renters into the suburb, which will diminish the renter owner occupier ratio. So we look for that indicator as well. We also track the demand side indicators. So what we look for is basically affordability. For an example, demand and supply ratio is very strong. Like we have more demand and low supply. But in a case, if there is no affordability. So in affordability section, we track two things. First is the buying affordability, and another one is the renting affordability. If suppose the buying affordability is very high, where in a case if suppose demand and supply ratio is very tight, and if the owner occupiers are able to afford more amount of mortgage, then you will have a more growth on the properties. That's why we look at the buying affordability as well as we look at the renting affordability, because whenever you look at the price growth is inversely proportional with the rental growth. So if there is a more rental growth, if there is a more rental affordability, and in a case if suppose more rental demands are created, which will rise the rentals, and that will impact onto the price growth as well. So we look for the rental affordability as well as the buying affordability. We look for the demographic changes, very important, because for an example, we look at the suburbs where, for an example, Parag gave an example of the Kellyville, where when we track the socioeconomic index of 1 to 10, so 10 means the highest, where the 1 means the lowest. So basically Kellyville is sitting at 10. So whenever we see the area is super high socioeconomic area, that means it's more desirable for owner occupier, where the rental yields are less because the property prices are higher. So in that case, which kind of socioeconomic area which we need to target? When you're investing, we need to do the balance between the capital growth as well as the cash flow. For an example, I can buy a property in Kellyville, then it will have a very high capital growth. But according to that, the rental yield will be too low. That means my out-of-pocket cash flow will be so low that I can't afford it. So that's why we need to manage whether do we need to go to the mid to low socioeconomic area, or do we need to target the high socioeconomic area? If you're targeting a mid to low socioeconomic area, what are the socioeconomic changes from last few censuses? So when we look at the last few census data, like from 3 to 4 census data, we can easily track whether the socioeconomic index or C5 index is changing from 1 to 2 or through to 3, or it's been sitting at the same place. If the socioeconomic index is changing, that means affordability is increasing. Good income earners are moving into that area, and because of that affordability, plus if you have a shortage of demand and supply, that means you will have a price rise. So we track the demographic changes as well. We also look at the auction clearance rate. Higher the auction clearance rates, better it's for the growth. That means the property market is getting into the boom cycle. So we track that number to understand how the current demand and supply ratio is created. We also look for the rental turnover. Very important. If you have very tight vacancies and turnover is too high, that means basically the rental tenure is very low. Or whenever you put the property into the market, within a week or two, your property will be in the market. The vacancy rates are very tight, and then that will be good for the price growth. So we'll track that as well. We also look at the demographic changes. We look at the population growth. Population growth is very important. So we look for multiple censuses about, okay, from last 2 to 3 censuses in that particular significant urban area or entire council, how much is the population growth? If suppose the population growth is above state average, then we see, okay, we track multiple censuses to understand what is the population type, how much is the family sample size. We also look at, okay, what's the age group of the population which is moving, whether the retirees are moving there or whether the young population is moving there. In the population, from the population growth, we can define whether more renters are moving there or more owner occupier. Because if the more young families are moving there, that means they'll look for the new houses, and then that will have more growth onto the area. So we track the population growth. We also look at the immigration numbers to understand how much is the immigration in that area. Immigration numbers are more when there is more jobs created into the economy, and if there are more immigrants or more interstate immigrations are happening, that means more numbers of jobs are being created because of the infrastructure growth. So we track the immigration numbers as well. We also look at the median income. It's very important. So for an example, currently, if we'll take an example of the Ipswich Council, where current median income are in between $1,200 to $1,400 a week, and according to that, the current median prices, if at 6.5% interest rate, if they have to repay the $700,000 mortgage, then they have to wait for another 52 years. That means affordability index is for 52 years, which is not good. That's why median income are very important. If median incomes are higher, and then if suppose demand and supply is lower, and in the entire area, if you see the more population growth, and that will create a good affordability within that entire council, which will give you the price rise. So that's why we track the median income, as well as we track what's the percentage growth into the median income, and we also track, okay, what is the forecasted median income of that particular area. So we track that into the system. We also look for the socioeconomic index. As I said before, we track the CFI index. If the CFI index is increasing from last 1 to 2 or 2 to 3 censuses, that means that the entire area is gentrifying. And if area is gentrifying, that means good income earners are moving into that area. That will give the price boost. So we track that into the system. We also look at economical indicators like job opportunities. When we track the job opportunities, we look at, okay, what kind of jobs are there? Either they are the permanent job, or either they are the jobs which has been created for the temporary. Like if you're building a big solar farm, you will have 10,000 workers working there, and then after that, the most station worker will be around 500. So job opportunities also has a job diversification. So in the system, we look for the employment diversity. We don't want it to go into this council where the entire area is dependent on one industry, like mining, for an example. So that's why we, in a system, we have configured something called as the employment diversity. So according to the job categories, we have created a job concentration risk. Wherever the job concentration risk is more than 20%, that means in one major category, that will be highlighted as the risk in our system, and then we handle it accordingly. So we look at the job employment diversity as well. We also look at is there any new hospitals created, school infrastructure has been created, shopping and amenities which invite more owner occupied to move there. So because when investors comes out of the market, your next competition or next wave is through the owner occupier. So wherever the owner occupier ratio is higher, wherever the affordability within the owner occupier is higher, wherever the incomes are higher within the owner occupier, and if suppose in that entire area, if there is a solid crunch between demand and supply, you will definitely have a long-term growth. So that means we track the short-term growth with the help of the demand and supply related indicators. Also, we track the long-term growth with the fundamentals. So that is already incorporated into the system. We also track the affluency score, as I said before, that is related to the gentrification and the socioeconomic index. So we track into the system. We also look at the future projects. What kind of new infrastructure is created? If there is a new infrastructure has been proposed, why that new infrastructure is being created? Whether it is being proposed to serve the current population, or it is to serve to new population growth. If the infrastructure creation is to serve the future population growth, that means it's good, because in that case we know, okay, there will be a more population growth, which will that will be because of the more jobs creation. And if you have a solid crunch between the demand and supply, and if more population is coming up, and if all the fundamentals are matching, that means you will have a more growth into that particular council. So we track that. We also track the transportation and the power related infrastructure. That is very important when we say there is a massive boom into the infrastructure related to the transportation and the power. That means more related engineering projects, heavy engineering projects are being created or involved into the entire council or region, and that will give the additional boost to the incomes, so that which will create the more jobs. So we track the transportation and the power related infrastructure as well. We also track zoning changes. For an example, according to the strategy, if I'm buying a property which is very close to the CBD, and if I'm getting into the property where I'm holding a bigger land with the older houses, in that case this rezoning does matter a lot. So in a case if you track those changes, then we can target the area where the zoning changes have been applicable, and we can actually add those assets in our portfolio. So we track that, we track the zoning changes as well. This is a glimpse of a backend database of Propel Next. So Propel Next, where we put the scores. So when you look at the scores, right, scores are in between 1 and 5. The 1 means lower risk, 5 means higher risk. So when you see at the left, that is called as a statistical area 3, which is called as the council. So when you look at the research, the council is the one where we have to start with, because council has a bigger boundaries. So reliability of the data is much cleaner. So we start with the council, and then we percolate towards the statistical area 2, which is a suburb. And then within the suburb, you have the small pockets called statistical area 1. So we start our suburb research with the council. In that, we look for the past 10 years growth. And in any council where the past 10 years growth is very good, which is more than 7 to 8 years, 7 to 8%, then we track that as a low risk, and then we add it to the filtration system. And then we track the current growth, what's happening from last 1 month to 6 months. So in that we put, okay, what if suppose from last 1 to 6 months, enough number of transactions are happening, then we check that. So that's why we put 1 month price change. We also track the inventory. Inventory tracking is very important, because if you don't have more stock on the market, but if you're like 7 to 8 months of inventory remaining, that means it will not create more demand into the area, because still availability of more supply. So we track the inventory. Wherever the inventory is more than, inventory risk score is more than 4 and 5, we don't get into that area. Then we look at the inventory trend. So we have the trending engine, which gives us, okay, currently, what is the current inventory? But in a case, currently, if the inventory score is very low, but the inventory trends are like increasing, that means in future, you're going to get more supply, and that will calm down your growth. So that's why we look at that inventory trends as well. We also look at inventory forecast. So in forecasting engine, we see, okay, in next 6 months, how much inventory is going to be infused into the entire council. So, and then we take the actions accordingly. We also look at the days on market. If the days on market score is better, that means currently the properties are moving faster. That means it's creating enough demand into that area. We also look at the inventory days on market forecast. Currently, if suppose days on market score is very good, it's tight, but forecasting is saying, okay, it is going to be increasing. That means the market is calming down, and then we have to pick and choose our set. So that's why we check the forecasting engine. We also look at fully owned score, where we see, okay, how many percent owner have fully owned the houses without mortgage. Higher the score, better the area. That means the area is more stable. They have more owner-occupier ratio, and then people are not selling that fast. That means that fundamentally that area is good, which will have a long-term growth. We also look for buying affordability as well as the renting affordability. As I said before, wherever the buying and renting affordability is better, demand and supply gap is very strong, and you have enough population growth. That means fundamentals are better as well as the demand and supply gap is low, which will give the highest price growth in the future. So that means we track a short-term growth as well as a long-term growth in the system. So in this on this window, you can see the population tracking. So we track the population from the multiple censuses, and we see, okay, in which councils how many percent population is growing, and we have certain threshold. If it is having a population growth above state average, which is good, we track that population growth. We also track the population sample size, family sample size, as well as the age groups. We also track the jobs by category. So basically, when we look at the job diversification, these are the job categories where, if you see at the end, extreme end, wherever the concentration risk is more than 3, that means basically that entire area is dependent on a single type of industry. That means, and if for an example, if it is a small mining town, or small remote satellite towns where the entire economy is dependent on a single industry, then we have to analyze that area very carefully. That's why it's been added to the system. So from Propel next, what did we achieve from last few, like we have been using this system from last more than a year now. So around 7 to 8 months ago, most of the people are investing towards the Southeast Queensland, where the competition was too high. People were overpaying on the asset. Valuation was not stacking up. Also, the biggest challenge is the rental proportion is more than 50% in a lot of suburbs now. And that entire area is dependent on a single industry. The job diversification risk is too high. That time we found the regional NSW as a new pick, according to our research. And then we started investing over there. We found affordable property with a higher discount. We found a lot of dual income properties because there was a less competition. We got a great discount on the property. Yields were better. Now, from last 7 to 8 months, we can witness around 15 to 20% capital growth. So that's the beauty of the Propel Next. So next, what are the next location which to look at for the future perspective? The number one is Shepparton. It's in the regional Victoria. If you look at the affordability score, it's very good. It's most affordable location where the rental yields are better, incomes are moderate, but property prices are too low. Affluency wise, you need to avoid few pockets, but yes, it's increasing. So if you look at compare the three censuses, the affluency changed from 30 to 50. Demand and supply gap is increasing now, so score is better. Employment diversification is nice. So overall score is 83. That means these are the councils where you can pick and choose the asset. Also, we need to look at, okay, basically you know to avoid certain pockets and then avoid the flood zones. But if you're looking for the affordable range of the properties with the good rental yield and a decent capital growth in short term as well as a long term basis, Shepparton you can look at. The second one is Dabre. In regional NSW, extremely strong in economy, affordability wise is good. The property prices are in between 500 and 600. Rental yields are around 4.5 to 5.5%, depends on the type of the asset and how much you negotiate. Affluency wise is better, especially if you go towards the South Dabre, it's better. Demand and supply indicators are strong. Absolutely, there is no supply but high demand. Employment risk is lower. Overall score is 85, which is good. Third is in Western Australia, city of Bunbury. Highest affordable location, very close to the Perth city, around 100 kilometers towards the south. Nice coastal lifestyle, lot of infrastructure project from the government. Affluency wise, need to avoid few pockets, but there are good pockets as well. So affluency have increased. Demand and supply is a lot of gap. Employment diversification is good. Overall score is 78. That means if you can negotiate the asset with the good rental yield, then you'll have a better scope in the future capital growth as well. City of KC, that's in Melbourne. It's not a most affordable council because I put the one research last time about the city of KC where the population growth is stronger. So if you compare the two censuses between 2016 to 2021, the city within the Melbourne, the city of KC got around 36% population growth. So it's most desirable for the owner-occupier council. But in a case if you can afford a good negative gearing like around $1,500 a month, then that's a council to look at because there is heavy demand from the owner-occupiers. It's affluent, few pockets to avoid, but there are few good suburbs where you can invest. Demand and supply has a good gap, depends on the pocket where you go. If you go towards the Clyde, there is lot of supply, so you need to avoid few oversupplied pockets. Employment diversification is good, affluency wise good people. So that is the council which to look at and then have to take a decision when you can afford the heavy negative gearing in Melbourne. So overall score is 76. The last is Albury Wodonga, very strong from last 6 to 8 months. We can see heaps of growth, still very affordable. You can still find the properties are in between 470 to 520. There are especially few suburbs where most affordable. They are good suburbs for the owner occupier also. Affluency wise, if you avoid few pockets, great suburb to invest. Demand and supply has a lot of gap, extremely high demand, lot of investors, good rental yields, good employment numbers. Employment risk is too low. overall score is 80. So so in a case, if suppose if you're looking for your next purchase, in nutshell, don't look at the demand and supply related indicators. Look at in perspective of when you're buying a property, you are just not buying a property for 2 years. Make a property plan, make a strategy, and take an informed decision with the data. So when you just look at the demand and supply indicator, the trends can be manipulated. So look at the fundamentals, like, okay, in future, what kind of population will be coming there? In a case, in next 5 years, shall I expect the similar kind of population growth? Make a plan of 10 years, and in next 10 years, how much would be the population growth? What is the income? What kind of job infrastructure is created? That means your property will have a good performance. So from here, I would like to hand over to the Parag.
Hey, thank you so much, Julius. Thank you so much on what a lovely presentation, all about data and how do we really get into finding a great property? How do we really get into finding something which suits people? How do we really get into something which we can find out? We can do it ourselves. We can find out a great suburb. We can go online. We can go and talk to people, but find a suburb which suits us. Which means, for me, socioeconomic importance is very important. I choose that kind of suburb. For me, those 4 categories we had briefly discussed, which one is more critical for me, where the cash flow is more important for you, capital growth is more important for you, neutrality is more important for me, lower capital growth is fine with me. What all stuff is there? So we've taken a few examples and we've understood what all stuff can really mean good for us, and that's what drives what our choices are going to be and how we will go and find a great suburb to invest into. But why now? And anyway, so I don't think so. I should not even talk about the first point. Interest rates are reducing and everybody knows it. It's not a secret anymore. It's out there in the market. We are seeing demand and supply, and you can look at this anywhere. I'll tell you, I was with a friend of mine and we were at an auction on Sydney on this Saturday, and he wanted to buy a property that's in one of the suburbs, and he was there for the auction and I was along with him, and they were expecting that the property will come for 2.5, 2.6 million. That's what it was there. 2 or 3 people bidded, and then the bidders, and they had registered. Auction starts, bank 2.8, and who was expecting 2.5, 2.6, that was the guide which even the real estate agents were talking about. I know, and let's not get started there, but eventually sold for 2.95. All right, that's what the latent demand can do. Somebody really liked that house and just went straight bang onto it, and obviously good luck to them. They've got a good property, but that's what it is there. Very great latent demand sitting in. Demand and supply gap is increasing right now, and very weak construction pipeline. You can read all the media reports when you read that stuff. Construction pipeline is weak. That's because builders are not in great health. The construction cost is still very high. Labor cost is still very high. Land is not coming cheap. So it's not a great place to be in. Infrastructure, it's all over again, we're talking so much about it. So much things are happening. There is a great incentive to FHPs, which is driving the owner-occupied demand. And that's what brings the opportunity for an investor to come in, cash into a great location, find out how you can get a next winner, how you can get a couple of years. When we saw, we took an example of WA Bertram, 123% growth in 5 years. Why not? I'll die for that. Give me a few more locations like this, and that's it. My financial planning is sorted. But anyways, that's what we are wanting to do. We are wanting to achieve a great result for ourselves. We are wanting to achieve a great growth for ourselves. And that's what we try and work on. That's the reason why a lot of people like us. That's the reason why a lot of people have spoken good things about us. But anyways, this is not about me. This is all about how do we really find out a great location. And what we are going to do now is we are going to be talking. We're going to take a lot of questions which have typed in. I swear we'll have a good evening ahead of us. But if you really don't want to put the question out in the middle and you want us to take it one-on-one, happy to take that. It's a no obligation strategy, just an education one. We really love to talk to people and give away what we can. That's a little bit which we can do to all of us. But having said that, if you have any questions, please, you can type in right now. We are there to listen, we are there to hear, and we are there to answer them right now. But if you really feel that this is not the time you want to ask and you want to have a longer discussion one-on-one, I had just put our details on the screen and I'll put it again in some time. But right now, let's get into question answer session, okay? Let me start off. It's come on both the chat and the Q&A section, but let me start off. Okay. How do you choose the correct property? Do we really need to consider land or property or suburb? Such a great question. Really nice one. Okay, we're talking of property. What do you mean by that property? The land or the suburb or the property? What do you say, Julius?
It depends on the strategy and the requirement, because when we sit for the strategy with the clients, we need to understand the financial requirements first and what they want to achieve, and we find a suburb according to the strategy. Probably I would have when I'll start, I would certainly go for the property which will have highest capital growth. But I don't only look for that. I also look for, what is my risk appetite for that particular property? I can actually buy a property which is 1970s build, which will have a highest land component, close to the CBD. It will have a rezoning opportunity. It will have a ancillary dwelling opportunity, but it might have a maintenance.
Yeah.
So sometimes people are just banging on the land, but it depends on where you're buying that also.
Absolutely.
So for an example, I'll buy a property with a bigger land size very close to the CBD, where the suburb has lot of supply crunch, then yes, it's good.
Yeah.
If you're going towards super regional centers where the land has very less value, but the construction cost is more than $3,000 or $3,500 a square meter, or something like in regional Queensland, then I would buy a property which has more value. Yeah. So I will literally go with the good build size property, not for the land banking. So that we need to understand what's the risk profile and where you're buying. The location is very important. Also, when you look at, when you are in a first stage where you wanted to get into the more capital growth kind of scenario, what's the cash flow is very important. You might buy a property where you'll have a highest capital growth.
Yeah.
But if the rental yields are around 3%, then you can't buy your next property because you will be so much negative.
Yeah.
That's why there are so many variables into it, and then we define the suburb. So because every capital cities or every regional town center, every council will have good suburbs and bad suburbs.
Absolutely.
And it's also on the deal. We can still go to the Perth and get a very good deal around 50,000 below market price, which will be around 10% growth uplift.
Yeah.
So it depends on the strategy as well as the risk profile, and then there'll be so many variables.
Absolutely correct.
Yeah.
Absolutely correct. No, that's a right way to take that. In fact, that's a good way to take that. Suburb is always a higher level thing. Yeah. But after that, when you're looking at a property, I'm assuming property means the constructed house, which is where you get a rent, or you look at a bare shell land, which is there, or you just want to look at a larger land size. All of these will depend upon your strategy. What fits with you? What do you want? What is your definition of a good suburb? That's important. And everything is fine. For me, land is fine, large land is fine, small house, 1 bedroom itself is also good with me. A rundown shack, which somebody just pays me $100, that's good for me because I want land bank, good suburb for me. But somebody else, they want rental income, different suburb. So that's all on your strategy. Okay, let me quickly move on to the next one. I think we are falling behind. Okay, where are the major cities on the property clock right now? Which capital city would you see a 1 million purchase price do best for cash flow, capital growth, assuming new property? All right. What do you say for that?
Yeah, so at this stage, if you look at the major capital cities, I'll give you a bit perspective about it. Okay, Adelaide is strongest, followed by the Perth. Adelaide, the rental yields are in between 4.5 to very close to 4.7, 4.8%. Land component is better because entire Adelaide, most of the council is getting through the rezoning. There is not much supply in the Adelaide. If you go towards the extreme north, towards the Munapara, from the SA water, there are a lot of hiccups because the connections are not. So land development is very slow. And then because of the first home buying stimulus, basically, there is a heaps of competition within the first home buyers.
Yeah.
So property prices are soaring nicely. Similarly, in the Perth has the good component of good suburb as well as a bad suburb.
Yeah.
If you go to the still good suburb, good councils of the Perth, where the people are earning around $2,600, $2,700 a week. Yeah. Properties are double brick.
Yeah.
Good quality.
Yeah.
Rental yields are in between 5.2 to 5.5% yet.
Yeah.
Massive infrastructure boom.
Yeah.
Massive population growth. When you look at the property type, easily you can achieve 4-bedroom, 2-bathroom, double garage with property prices are in between 650 to 750.
Yeah.
With the rentals are in between 700 and 750
yeah.
per week. Also, the vacancies are very low, and then supply side indicators are very strong. Like there is no supply at all.
Yeah.
So multiple councils, multiple suburbs within the Perth are very strong.
Yeah.
And they have a capacity to grow to $1 million.
Yeah.
Because of the affordability, because of the demand and supply crunch, irrespective of any media news.
Yeah.
Yeah. Third, when we look at the affordability wise, Brisbane is too expensive now.
Yeah.
The major issue in the Brisbane is there are good councils. If you go towards the Moreton Bay or any expensive Redland Bay councils, they are very close to $1 million purchase.
Yeah.
Where rental yields are below 4%.
Yeah.
You can see a bit of capital growth over there because of the Olympics, and in long-term basis, definitely yes, you will get a good capital growth. But there are few councils like Ipswich, for an example, it's overpriced. Yeah. So affordability-wise, affordability is sitting at 52 years. The socio-economic indicators are like worst. Incomes are in between $1,200 and $1,400 a week. So that means for them, whatever it has been achieved now, they are already overpriced. Absolutely. So we need to avoid those type of areas. For an example, in Melbourne, it's a very different topic. If you go towards the western side, more land, it's affordability, but still rental yields are worst. For an example, in Melbourne, rentals are not rising because of the extremely high supply of the rentals.
Yeah.
So for an example, if you feel like, okay, if you buy a property where you have a 10% property price growth, if your rentals are not increasing by around 7 to 8% or 9%,
yeah,
then for the next investors, the rental yields are below 3%.
Absolutely correct.
And that's so much of negative impact.
Absolutely correct.
So when I wanted to get into the capital city, for me, I still have a better opportunity within the Perth, Adelaide, followed by the Brisbane, and then Melbourne. Okay. But it doesn't mean that Melbourne will not grow. If you can afford so much of negative cash flow, then there are good pockets in the Melbourne also where you can buy. Yeah. So it depends on the individual situation.
That's so right. That's right. It depends on individual situation. All states are doing good. All states are doing good for themselves. But whether it fits with you or not, that's you. And that's your strategy. There is no one shoe fit all style here. It's all one-to-one. Okay, I'll quickly go on. Some really, really interesting questions, guys. And we know we are reaching close to the time, but I would love to carry on. It's some wonderful ones, and I would want to answer as many of them as possible. Very quickly, it's about Austral. Sorry, guys, a lot of you are raising hands. Just keep on typing questions because I understand that, and I would love to take your questions, but we can't talk face to face. Just keep on typing your questions, and I will answer all of them. We'll just keep on going till we are able to answer as many. Okay, next question. Is Austral the best for living or to invest in 2 to 5 to 10 years? That means I'm assuming short to medium to longer term. What current profile data indicates about Austral's growth?
Yeah, okay. So for the Austral, basically, it has benefited a lot because of the new infrastructure. Also, when you look at the expansion of the metro, it is still Bankstown, so that entire area will be covered over the Metronet. But especially in Sydney, when you invest, when you go above to more than $1 million purchase, your rental yields will be significantly drop below 3%. Yeah. So again, it's a question of strategy. In a case, if you can afford a good negative cash flow on your investment, then yes, it will have a good capital growth in future basis. From last 4 to 5 years, it has been doubled by the prices. Yeah. In Austral, whatever the land availability you have now, where the land sizes are in between 260 square meter till 320 square meter with the smaller frontages. So you are paying for the houses, which is a depreciating asset. Because of the good population growth, yes, we can expect some good capital growth in future, but followed by you will have a great, you'll have a lot of negative gearing. Yeah. So if you can afford that negative gearing for the longer time, which is a net negative in your portfolio, then yes, definitely you can look at the Sydney.
All right. Yeah. A different question. Are there still any opportunities to buy houses around $350,000 to $400,000 with neutral or positive cash flow and possibility of capital growth in next 10 years?
Yes, they are, but it's diminishing. That's what I'm saying. Affordable pockets are diminishing, and in next 2 to 3 months, it will be too hard to find out. But even though we closed few deals in that segment from last 3 weeks, where the rental yields are in between 5.5 to 6%, and that area is certainly getting through the good boom cycle, provided that those properties will not be like a brand new. They will be like a little bit of properties will require a little bit of renovation. So there will be cost attached to it in future also because property required a maintenance plan. But yes, at this stage, these type of pockets are available, but they are very rare.
All right. how much do you charge for the buyer agent services?
Yeah, so we do charge $13,000 plus GST, out of which we charge $1,100 upfront, and rest of the amount is payable when your property contract will become unconditional. In that, we do a strategy call. We sit with you, understand your requirement. Me and Parag sit with you, I can build your strategy around it, because Parag is very good in finances and the strategy. According to the strategy, we start buying properties. We do find all the properties, we negotiate. Most of the properties off market. Most of the properties are in well data driven locations where the property will have a good significant capital growth. We do a due diligence on the property. It's a rigorous due diligence where we see all the videos of the property. We look at easements, flood zone, fire zones, all the disclosure caveats on the property. Then we give you all the reports. We look at the cash flow of the property. When we present the property, you'll have all the reports in hand. Then after you select, you like the property, we work on the contract. We have an in-house convincing shop. They look after the contract. And once you sign the contract, we work with your mortgage broker to get the loan approval. We arrange the building and pest inspection. After the inspection, we address all the issue according to the state rules. If it is a Perth, then only major structural issues will be addressed. And then if it's other state, then probably we can negotiate on the pricing. Before your property settles, our property management team will come in contact, and then they'll sign a management authority agreement. And as soon as the property is settled, it will be in the market for the rentals. We manage your entire portfolio, onboard your portfolio through our in-house mortgage booking system. We do a valuation of your properties, and then whenever the property is equity ready, we look for the next property. So we work on a portfolio approach, and then we give you end-to-end solutions.
All right. A related question. I'm jumping between here and there, between the chat and the Q&A. How do you check the quality of a house in a different location to where you are based?
We do have a few local buyer agents across the country, as well as we have a good types with the property management agents. Also, before we buy the property, we visit the location. So most of the locations, that's what when I was discussing about the data, we have statistical area 3, statistical area 2, and then statistical area 1. We have in-house maps, which tells us which statistical area 1 we have to target. So within the suburb also, there are the pockets where you could see a different socioeconomic indicators, and then you can see the different prices. So we target the specific streets. We go there, we visit the streets, and then we talk to a lot of real estate agents as a property manager. So when we look at the property, we do 3 inspections. First is your visual inspection with the property manager. Then we arrange the building inspection with the inspector. And before you settle your property, we do a pre-handover inspection for the property to check, okay, all the appliances and the electrical are in the working order, plumbing is good or not. So basically, we make sure that property will be in the good condition and it will be delivered as we have seen in the videos.
What overall score would you give for Mildura, Victoria?
Mildura, Victoria is growing from last 1 to 2 years now. It's in the news, and then a lot of people are investing. So what we have to be very careful with the smaller markets are, because for an example, you look at the state, it's a very big market. The inventory size is very big, and then you have multiple councils. So you can apply multiple strategies of like ripple effect. You can look at the neighborhood price balancing. If suppose one of the suburb is hot, and then if you're not able to secure something, you go to the nearest suburb. If all the fundamentals are good, then it will have a ripple effect, and then you can buy there, start buying this. There are a lot of strategies you can apply. In the smaller markets, when the prices start growing, then the market exhausts a lot. According to the data, yes, Mildura is still in a good growth cycle, but it has grown a lot also. So you need to select a good pocket within the Mildura, and then price has to be correct. If you overprice the property, then you will not have a lot of capital growth in future, because it's a small regional town. It's not actually a regional, it's a super regional. So according to the data, yes, but it will come to the deal in that case. If you're able to find a great deal in the Mildura, then it's fine.
Okay. Hi, Julius. Okay, first is hello to Julie. Maybe you can type in your question. There's another question. Hi, Julius. Dabre has grown a lot between 2021 and 23. What's the future growth potential? Also, South Dabre average price around 600. Is it still affordable for locals?
Yes. So in Dabre, if you look at the basically incomes, They are in between 1600 to 1900, depends on which significant area one you're looking at. Second thing is Dabbo is historically very low on basically stock. Also, if you look at the 10 years price change, historically it was growing at around 78%. At this stage, the entire country is suffering from affordable housing where you want it to be in between 500 to 700. In Dabbo, if you match the income versus the local economical indicators, plus amount of demand and supply indicators, we still have an opportunity to buy properties in between 400 to 600, depends on the property type. So if you manage to find the property which is below around 5 to 10% below market price, that's the point you have to start with. In Dabbo, you can actually get into the property where you can spend around $800,000 and get into the good owner-occupied area, which is the expensive side of the Dabbo. But you still have an opportunity because we just buy a property in Dabbo required around 10 grand of renovation for $395,000. So if you are confident and then if you can research more or if you talk to a lot of agents, you might get a lot of properties within that section where, okay, a property might require a little bit of work, but you can save around $50,000-$60,000 on the property. So there is a lot of scope within that pocket of the Dabbo.
Great. What's your opinion on Townsville?
Townsville is good. So in Townsville, few areas to avoid. So if you look at the Townsville, then look at the area which are more affluent and the more owner-occupied driven. In Townsville, don't look at the land sizes, look at the houses, because as I said before, land prices are cheaper, but the housing cost is around $3,500 per square meter. If you end up buying a extremely rundown house with the bigger lot, and if it is outside of the Townsville CBD, like if you're in Diragun or if you're buying somewhere in Kelso, where the property prices have significantly soared, and then according to the incomes, affordability is soared as well. But there are a lot of good pockets within the Townsville, like if you go towards the Bushland Beach, Burdle, Bole Plain, Mount Lovisa, these are the pockets where you still need to get into because it is still the owner-occupied driven market. In Townsville, if you are able to buy a property in between 550 to 600 in 4-bedroom, 2-bathroom kind of range, these are still good properties to buy. Townsville has a good two major economical booms. When you land into the Townsville airport, you could see F-35. Also, thrice a day, you can see the F-35 sorties in the ground. That means it's a huge defense infrastructure. Townsville Hospital is grown a lot. Even that was the election promise that basically they have a Townsville Children Hospital now. And it's just not a hospital, it's a medical college. And it's growing, so you have a lot of expats coming up. Housing supply is extremely low. Also, to build the house, you need at least in between 12 to 18 months. Population growth is much higher and affordability is much better. So if you select a good pocket within the Townsville and if you avoid the flood zones, then it's a good area to invest at this stage.
All right. There are quite a few locations which people have asked, and we're going to go to them one by one. But I think someone who had asked us about the fees has asked a follow-up question. So very quickly, you can take on that. Are all these things included in the 13K cost? So I think what all stuff which you had spoken of, are those all included in the 13,000 cost?
Yeah. So basically, excluding the building inspections and building inspection, that inspector cost and conveyancing cost. You will have an option to choose your own conveyancing, or else you can choose our conveyancing also, which is like best in all the state.
Okay. My good friend Amol's asked a question. Melbourne property seems to carry a lot of negativity, such as land taxes and low rental yields. What are your thoughts on this? I have a few more locations to ask. There are some good relocation questions. Please, let's start with this one.
Yeah, okay. So in Melbourne, we are not against Melbourne. But what I mean to say is basically, it's not negativity, it's a fact and the data. So when you extract all the data sets and when you look at last 12 months of history of rental rises, as well as when you look at the last 12 months of property price change, when you have a good rental increment, then you can expect, okay, the yields are increasing, your yields are around 4 to 4.5%, then you can expect around 5 to 10% property price growth. Especially in the Melbourne, there are a lot of townships where the yields are in between around 3.5 to 4%, that is gross. But it comes with a lot of burden of land tax, as well as that means the net in the Melbourne is pretty low. The moment you come up from price growth of around 7 to 8%, and if your rentals are not catching up, then you will be at around 3%. When you're at 3% gross, that means you will be around 2.5% to 2% net. And that's a place where then you will be spending a lot from your pocket. So in that scenario, you lose the investors' wave because investors are very, very cash flow sensitive. So for an example, if you're growing in the prices and if the rentals are not coping up with the price rise, then that wave will be cooled off. So in Melbourne, if you wanted to buy something and if you can hold up, get into the pocket where you can see a lot of extremely high owner-occupied demand, like Sydney. In Sydney, there is not a lot of demand from the investors, but Sydney prices are growing because of the owner-occupied demand. Similarly, in Melbourne, there are few councils like KC. Just get into the good pocket of the KC council and then look at the properties which has extremely high demand. So if you look at the KC council like suburb like Cranbourne, Carrum Downs, if you still go down to Mornington Peninsula like Frankston, there's heaps of demand from the owner-occupied. Prices are rising there. But when you go towards the broad perspective of the Melbourne, the entire territory, then there are a lot of supply-related issues, as well as because of the lot of supplies, you have more rental properties coming up, so rental rise is not happening, and that's impacting on your price growth. So that's why you have to be very careful while buying a property in Melbourne.
All right. Okay. You partly answered Shree's question about Sydney market. Maybe you can speak a bit more about it. Then we'll follow up with Adelaide, Smithfield. Then we have a question around Logan, and then we have a couple of more locations. So I'll just, I was forgetting which ones, but I'll go with them. Sydney market. Quickly, can you just have in 2 minutes?
Yeah. What are they expecting?
What do you think of Sydney market? Can you find property in Sydney?
Yeah, we do find property in Sydney. Depends on the client's requirement. Most of the property we buy in Sydney are for the owner occupiers, or they are high net worth individuals where they can afford a lot of negative cash flow. Then we try to buy properties in Sydney. In Sydney, there are great locations also for the development potential. So if you go towards the St. Mary's, or if you go towards the St. Clair, there are a few pockets of the Blacktown where you can actually hold a good land with the decent houses, where the rental yields are in between 3 and 3.5%. If you have any development mindset, Sydney is always short on the land supply. If you can hold the property, if you can build something on the land, then definitely Sydney is for you. In a case, if you're cash flow sensitive, then Sydney is not good for the investment.
Great. That's a right piece of advice. If you can't hold on to the properties with a negative cash flow, please don't buy in Sydney. Sydney is a very different market. It is only capital growth market. It is not a cash flow market, unless you had bought a few years ago and you're holding on to a gold mine with yourself. Otherwise, investing today is you need to be sure of what you're doing. All right, quickly. I have a question which I'll just answer very quickly, and then we'll go to the next location. We'll talk about Logan first, and then we'll talk about Smithfield, Adelaide. Okay, there's a question from someone who's asked something before as well. I have an investment property, plan to sell off the plan, currently tenanted 790K in 3+1 property on the 275 square meter Edmondson Park, NSW, CoLogic value 1.05 million. Can you get me a top buyer so I don't want to pay agent commission, rather you sell it off? I'm not sure I'm approaching this method right way. Guide me, would be greatly appreciated. Mate, it's like this. We don't really sell properties like this. Like what we really do, we would love to really help you out. We would really love to help you out, but we don't work like this. What we work is that if there's somebody who comes to us and says that I want to buy an XYZ type of property and your property suits them, then we approach you and we say, all right, you wanting to sell something, here's the person who suits the kind of property you're selling and it will fit with them. That's the kind of work we do. We don't have stock available with us off the shelf and then we start offering to people. Then we are not doing the right thing. Then we are not making a strategy for you. If you were to come to us, or if anybody else were to come to us and say, can you get me a property? We have a questionnaire. We talk to them. I understand what we do. First couple of properties, we get a calibration done in terms of how and what you really want, what you really think in a property. What suburb would you? Suburb is obviously selected earlier, so and then we find something, not the other way around. But yeah, if we can have a chat, we can have a chat after this meet, and we'll try and help you out as much as we can through our contacts, through our people who are looking for something as an owner occupier. Why not? Anything which works. But anyways, quickly moving on to the next one. What do you think of Logan?
Logan is a very big council. Starts very close to the Brisbane CBD and ends up very close to the Gold Coast. So now Logan has the good areas and the bad areas. Even though Brisbane is growing, but if you look at the historical growth of the Logan, it's almost 100%. Yeah. So if you're getting into the good areas of the Logan where there is a lot of owner-occupied demand, yes, the area is still growing, There are good properties where you can still have a good dual income properties and good income, but still depends on the strategy. It's just not about the council. Probably in my strategy, Logan will not fit, but probably your strategy, Logan will fit.
Yeah.
So it still comes to the strategy and what's the requirement of the individual strategy. There is nothing wrong in the Logan. Logan is good. It's growing. There are good pockets. If you find a good property which is around $50,000-$100,000 below market price from the good buyer agent, then definitely why not? Logan is a good pocket to invest.
Absolutely correct. Similar question, but this time about Smithfields, Adelaide. Is it good to invest in land or any new suburbs in Adelaide good to invest for 4 to 5 years?
If you wanted to invest in Adelaide now, try to be towards the northern side of the Adelaide and then be towards the Salisbury or a Territory Council, especially suburb like you go towards the Puraka, you go towards the Para Hill. There are a lot of suburbs, St. Agnes, Modbury. Over there, basically, it's heaps of owner-occupier demand. When you go towards the extreme north, towards Elizabeth, areas are a little low socio, and then there is a stigma. So people don't want to go over there. So if you come towards the places where, the other suburbs which I mentioned, where it's mix of investors as well as owner-occupier, like Ingle Farm. So these are the places where you can still find the properties in between 700 and 800, where you can get around 800 square meter lot, which will have a master plan neighborhood zoning. So that means you will have opportunity to do the subdivision. There are a lot of subdivision projects which are happening into the Adelaide now, because when you look at the master plan community like Stockland, yes, in towards the Monopara, Lakeview, till the Gawala, and then Virginia, Mount Barker, you can still see the little bit of growth, but over there, it's very expensive. Like on 300 square meter lot and 3-bedroom, 2-bathroom house, you're spending around 700 to 800. Instead, if you come more towards the CBD and buying a property which has a good land component, little older house, brick home, required little maintenance, that's a bit better strategy.
All right, thank you so much for that. Okay, keep on typing, guys. We are there to keep on taking those questions. We love this section. Okay, we love this section. All our webinars, I think it's never happened that we were able to take all the questions. We just run out of time, but we love that. And this is, I think, the best part of our webinars. Anyways, I'll not dwell on that. Okay, what kind of property is ideal for SMSF?
SMSF is it's different strategy. In SMSF, first of all, you can't get the property and subdivide and sell the land. You can't build the granny flat later. Also, it's a long-term strategy. So in SMSF, when you look at the property, you look at the property in perspective of, okay, next 10 to 15, 20 years, I would like to hold the property. So I should expect a good capital growth in long term as well as short term. I should expect the suburb where the rental proportion is less, more owner occupiers, and then good quality rental. And since it's expensive to maintain because it's a 7% interest rate, the yield should be better as well. So when you look at the combination of good house, which is like 4-bedroom, 2-bathroom, double garage, double brick home, good land size or moderate land size, but it's a good quality suburb with the good socioeconomy. And then if you find a good property which can hold for another 10-20 years, then you will have a short-term growth, you will have long-term growth. And it's a principal and interest only loan, principal and interest loan. So basically when you are repaying the loan, if for an example in 15 to 20 years you repay entire loan, property would have been in double in the price. Also, whatever the rental income you have generated, that's a passive income. So that's why in SMSF, we try to find the properties which are just not because the land is bigger. We find a property in a perfect location where you will have a long-term growth, where owner-occupier would like to go and live. Because that's not the strategy where you want to subdivide and then build something on. So that's the strategy for the SMSF.
Absolutely right. SMSF is a taxation-dependent strategy. You take an advantage of taxation. See, when you're talking of SMSF, you're looking at 3 key things. One part, the rental income which you get. Second part, you're getting a property which is going to grow in the long term. And third, most important part, you take advantages of taxation there. If you're looking at a property, these 3 things should be taken into account. If you're looking at doing any other thing, which we do as an investor, flipping and this and that, doesn't work in SMSF. So you should be very careful about what you do. And it's a good idea to be able to talk to maybe Julius or somebody else offline, and they will be able to get you more onto that. But here's next question from Shri. Apologies for the second question. Absolutely no apologies, Shri. This is the why we are here. Please keep on going. You can ask 3rd, 4th, and 5th as well. Is it fair to say that if 1 or 2 areas in a region heat up, then there is a probability that neighboring areas may heat up as well? I understand there may be exceptions.
There are likely the higher chances that it will, because when you look at the boom cycle, right? So when that in data there is the term called market cycle timing. Whenever the market cycle timing is higher, that means from number of years the area doesn't see a growth according to the CPI, it didn't match, and then all the new stock which is coming up, it's more expensive. There is more demand which has been created by a new population growth, but there is no supply at all, and then the property prices start growing because of the significantly high demand and supply gap. So for an example, when you look at the entire council, if one suburb is growing, then definitely there will be a ripple effect from that suburb to the next suburb. And then there's another concept of called neighborhood price balancing. That means, for an example, one suburb is around 200,000 expensive than the other suburb. So that means for the other suburbs, according to the socioeconomy as well as kind of population growth and the ripple effect, we calculate the number like in the dollar terms, where how much would be that number would balance the entire area, because probably one area will have a higher socioeconomy which is like 10 out of 10, but this area will have a socioeconomy of 8. So that means they can't be matchable at together. But what would be the difference? The difference will be percolated. So whenever we see the boom cycle, that means the ripple effect follows to the entire region. But there will be exception also. So like for an example, in 2021, when we were buying in Perth, that time Rockingham was in the buzz. But so like a lot of people were looking at Rockingham, a lot of media buzz, demand and supply indicators were strong. But fundamentally, if when we analyzing, we found out towards Hawking, because there were more owner-occupier, more incomes, more affordability. If you stand now, Rockingham grew from 500 to 700, but Hawking is around 850. That means amount of dollar value which you spend is 500 from both the location, but the Hawkins grown by another 150,000 more. So that's very important. You have to find the suburb which will outperform, just not grow. So these are kind of the terminology which we use in the data.
All right. Guys, we are at 8:25. We'll just spend 5 more minutes. I'm so sorry. I don't want to come in between your dinner time, but I think we've already shot really overshot. I have quite a few questions from people. They're asking follow-up questions as well. I apologize in advance if we are not able to take your question. Please book in a time. It's a no obligation one. There is no sales pitch there. There is nothing which we do. We just love to share. Very quickly, I'll put this on our screen. Sorry. And then you can book in, take a snapshot, take a picture. You can call us, WhatsApp, SMS, email, whatever suits you. But please do that, and we'd love to take that. Anyways, next question. Is it okay? Sorry. Shri, yeah. What do you think of apartment market, especially CBD apartments and Melbourne apartments? Very specific question.
Yeah, it's very specific, but I would like to answer that. So, apartment side, there are hiccups, and then there are a lot of ups and downs. So apartment is very much supply driven. When you look at the apartment and when they deliver the complex of the apartments or multiple towers, then immediately there will be a lot of supply being released to the market. Historically, when you look at the apartment market in Melbourne, we have a client who bought an apartment around 10 years ago, and still the prices are same or similar. So in the pricing of that apartment, if you're able to buy a property which will have a good land component attached to it, and then if you do a research properly, buy a property in a section where, probably it will be a little older house, good land size, good location, that will give you good growth. So the houses will always outperform the apartment. So basically, if you ask me for apartment to go and buy, definitely my answer will be no towards the Melbourne CBD. Probably there would be some exceptions, but assessment would be the house will always outperform.
That's right. That's what we've been seeing in the past as well. That's what historical data also points to. Right now, I think Australia is not really ready for vertical growth, unless the unit is in a very good location. You're overlooking a beach. You're next to a great park. You have something specific which is very nice. Those are ones which do very good. But if there are generic ones, they may or may not. But a lot of people buy apartments, mind you, and it's not. They sell very well. That's because it suits you. And that's what the whole essence of the webinar is. What suits you does not suit me. What suits me does not suit you. So we should buy what suits you and what fits with your overall objective. And that's very critical. Ajit's question, okay. He's asked it a little while ago. I'm sorry, I couldn't come to it. And there are few more which we couldn't come to. What's your way between single income property versus dual income property?
Again, it depends on the strategy. So if I'm buying my first property and then it's no harm buying dual income property also. But when we build the strategy, we define, okay, how many number of properties do you want? And then according to that, for an example, my first property is high capital growth with little negative. To balance my portfolio, we look at the dual income property. Because dual income properties are expensive. For an example, there are type of dual income properties. You either buy a duplex where you have common wall sharing, then it's a purely investor category product, where your next purchaser will be investor unless it's subdivided. If it is subdivided, that means you can sell one, keep one. That could be the another strategy we can keep in. If you look at the house and granny, that is the most hot sellable product, but that's expensive because you have two dwellings on the single land. That means the land component should be good. You need to get to the lot of council approvals. There's a building cost, but that's a good product. So it depends on what will fit in your strategy. Both the type of assets are good. Like more than 90% of the property purchases are single income properties. But if the requirement of the strategy is you need to have something high cash flow, then we look for the dual income.
All right. Very quickly, I'll just touch upon what KM has asked, and then we'll ask the last question for the day. KM, I understand you once I engage your so KM's question, once I engage a service at proposed fees, there a form of guarantee or assurance regarding the financial projections or figures you have provided for the property? Very, very simple answer, KM, and all our data comes from whatever is there in the market, whether it's from CoreLogic, whether it's from Domain, whether it's from any other property site, whether it's published by ABS, whether it's published by the statistics, whether it is Bureau Statistics, whether it's published by any other website, and it's all freely available. We do data mining, we do data scraping, we just collect data from all these sources, and based on that, we analyze. Freely available data, absolutely no problem. And you can independently verify any of these data if you have access to those sites. There are a lot of popular subscriptions which people take. There are DSRs and Arkistars and Suburb Trends, and a lot of those available, and you can really collaborate and you can really check all those data at any point of time, and you will find that there's not too much of a difference in the data. It's not the data which is important. See, what is more important is what you make of that data. And that is very critical. How do you understand and find out early trends? And mind you, trends are trends. Trends are projections. Trends are on the basis of what you are expecting things to happen. And expectations will never have guarantees. Expectations are data analytics. Expectations are done where you find projections, and expectations are done where you do predictive analysis, which can go either ways. And that's why when we say that you're wanting to take a call, definitely talk to somebody who's a professional, and that's how you work. Thank you so much. Last question before we go for the day. Sandeep, I'll not disappoint you. Couple of questions which remain, Pervez and other people, I'm so sorry. We'll ask those questions. We'll maybe answer to them one-to-one. But last question from Sandeep is it better to buy a property as PPR in a good school catchment? Example in Brisbane, Mansfield, Wishart, where properties are so expensive, rather in rent vesting. Which one is the best strategy in your opinion?
It depends on individual. Like probably there are a lot of people who would like to buy their first home in the school catchment and then live there. Or if you can't afford to live there, then rather than keeping the money in the bank, which is not doing the thing, so rather to go with the rent vesting. Rent vesting will give you that leverage that you live wherever you want to live, and then you invest your money in the properties and build a massive portfolio of the properties, which will give you enough equity with the right structure, and then you can still retain your borrowing capacity. So whenever you're ready with your deposit, and then you can withdraw that as equity and buy a next property where you want to live. So you can achieve both the objective. So it still depends on what you want to do or what is your expectations. But in a case, if you're not able to service the property where you want to live, or if you're short of deposits and if you're not able to buy, then rent vesting is the good choice.
Absolutely. See, rent vesting as a concept is very interesting. What it tells you is the word rent vesting. It tells you that I want to live in an X suburb, but I either can't afford to buy in that suburb or don't want to buy in that suburb because it's too expensive and I feel that I will miss out on multiple opportunities outside, or for some other reason. Then we start investing and still ride the wave. We start investing into other suburbs where I can buy, maybe for a cheaper property price, or maybe suburbs which are going to go faster. There would be suburbs which will go faster than Brisbane, Mansfield, or Wishart. But so I want to invest there, but I want to live in Wishart because it's a good suburb and my kids should be studying there in the school catchments there. Then what I do is I rent there and I buy wherever so that I don't miss out on the wave. That's what rent vesting is all about. Now, if you want to do that and for a reason best known to you, don't want to buy, definitely rent vesting is there. But in the end, like I leave you with this thing at the end, it's a happy family. A happy family decides together. If the family decides that I want to buy first rather than rent vest, you buy first. If the family decides that, all right, we are happy to invest and stay on rent, do that. In the end, you do what suits you, and we will discuss and we will also tell you the same thing. Do what suits you, find the good suburb for you, find the good suburb for you to invest. And if at any point of time you find that you are not able to find out a great suburb which you want to invest in, this is our coordinates on the screen. I'm very sorry, we have so many other questions which we can't answer. We've really shot to 8:30. We never shoot this far, but we've shot to 8:30 and there are still many to be answered. We are thankful for all of you to have come today and to have asked all your questions. Please, you can use WhatsApp chat, SMS, email, whatever suits you. Contact us and we'll answer the rest of the questions as well. Thank you very much for coming, guys. Thank you so much for being there. And we hope you have a great evening and a great week ahead. And I hope you enjoy from the rate cut which has happened today.
Have a good evening.
Have a good evening as well. Bye-bye, guys.